If you bought a house and paid for it in full, you would expect to be the only owner. You would have the keys and the deed. But imagine if you found out that the real estate agent had sold that same house to 100 other people. Imagine that none of them had the keys, but they all had a piece of paper that said they owned the house. And imagine that the price of your house was not determined by the physical reality of the building, but by the trading of those hundreds of pieces of paper. This is not a hypothetical scenario. This is exactly how the global gold market operates today. I am Tom, and this is The Wealth Collapse. Subscribe now to stay ahead of the curve, because when the history books are written, you will want to be one of the few who saw it coming. We live in a world of infinite money printing. Since the financial crisis of 2008 and accelerated by the events of 2020, the Federal Reserve and central banks around the world have created trillions upon trillions of dollars out of thin air. By every classical definition of economics, this should have sent the price of gold to the moon. Gold is the ultimate hedge against currency debasement. It is the only money that cannot be printed. It has preserved wealth for 5,000 years, while every fiat currency in history has eventually gone to zero. So why is it that despite the highest inflation in 40 years and the most reckless monetary policy in human history, gold has not reached $10,000 or even $5,000 an ounce? Why does it seem stuck in a trading range while everything else, from real estate to the stock market, explodes in value? The answer lies in a sophisticated financial mechanism designed to suppress the price of real money by diluting it with fake money. This is the story of the paper gold scam. To understand this deception, we have to separate the two markets that exist today. There is the physical gold market, where you buy a coin or a bar and hold it in your hand. And then there is the paper gold market, where banks and hedge funds trade futures contracts and unallocated accounts that claim to represent gold. The physical market is tiny. It is limited by geology and the hard work of mining. But the paper market is effectively infinite. It is limited only by the willingness of bankers to type zeros into a computer. The price of gold that you see on the news or on your trading app is not the price of a physical bar in your hand. It is the price of a futures contract on the COMEX exchange in New York or a spot claim in London. And in these markets, the supply of paper gold dwarfs the supply of physical gold by a magnitude that is terrifying to comprehend. Let us look at the COMEX. This is the primary futures exchange for metals in the United States. It was originally designed to help miners and jewelers hedge their risk. A miner could sell a contract today to lock in a price for gold they would dig up next month. A jeweler could buy a contract to lock in the cost of raw materials. It was meant to be a tool for price stability. But over the last few decades, it has transformed into a speculative casino that has almost disconnected completely from the physical reality of the metal. In the futures, market traders buy and sell contracts representing millions of ounces of gold every single day. But here is the catch. Almost nobody takes delivery. Depending on the month, over 99% of these contracts are settled in cash. They are just bets on the direction of the price. Because these contracts are rarely settled in physical metal, the banks that sell them do not need to have all the gold in their vaults. They operate on a fractional reserve basis. Just as a commercial bank lends out more money than it has on deposit, the bullion banks sell more gold contracts than they have gold bars. Some estimates suggest that for every ounce of registered physical gold in the COMEX vaults, there are over 100 ounces of paper claims traded against it. This is the definition of artificial supply. In a normal market, if demand for an asset rises, the price goes up because the supply is limited. But in the paper gold market, if demand rises, the banks can simply print more contracts to meet that demand. They can flood the market with paper gold to absorb the buying pressure. This neutralizes the price signal. It creates a mechanism where the price is determined not by the scarcity of the metal, but by the depth of the bank's pockets. This creates a bizarre reality where the price of gold can crash, even when there is a shortage of physical gold. We have seen moments where mints are sold out of coins and premiums on physical bars are skyrocketing because people are desperate to get their hands on real metal. Yet at the exact same time, the spot price on the screen is falling. This happens because massive amounts of paper gold are being dumped on the futures market. We often see this happen in the middle of the night or during hours when the physical markets are quiet. A massive sell order worth billions of dollars of notional gold hits the market instantly. No rational holder of physical gold would sell billions of dollars of metal all at once because it would crash the price they get for their asset. But a manipulator holding paper contracts does not care about the asset. They care about moving the price. This is known as a spoof or slam. They use the leverage of the paper market to paint the tape and discourage investors from holding the metal. But the COMEX is just one part of the problem. The real heart of the paper gold scam lies in London with the London Bullion Market Association, or LBMA. This is the center of the global wholesale market for gold. It is an opaque, over-the-counter market where the biggest banks in the world trade gold with each other and with central banks. In this market, there's a distinction between allocated and unallocated accounts. This distinction is the most important thing you need to understand if you want to preserve your wealth. An allocated account is like a safety deposit box. You pay a fee, and specific numbered bars are set aside for you. They are your property. If the bank goes bankrupt, those bars are legally yours and cannot be touched by the bank's creditors. But allocated accounts are expensive, and they are not the standard. The standard in the banking world is the unallocated account. In an unallocated account, you do not own any specific gold. You have a claim against the bank for a certain amount of gold. You are an unsecured creditor. The bank owes you gold, but they do not necessarily have that gold sitting in a vault waiting for you. They use the gold on their balance sheet to back up thousands of these unallocated claims. This is where the term rehypothecation comes in. Rehypothecation is a fancy financial word that means pledging the same collateral to multiple people. In the unallocated gold market, banks take the gold they have and lend it out or use it as collateral for other trades. They might lease the gold to a short seller who sells it into the market. They might use it to back a derivative position. They are effectively selling the same bar of gold multiple times. The person with the unallocated account thinks they own gold. The person who bought the leased gold thinks they own gold. And the bank thinks they still have the gold on their books. It is a game of musical chairs played with gold bars. As long as the music plays and everyone is happy trading paper credits, the system works. The bank collects fees and the investors feel safe. But what happens when the music stops? The entire system is predicated on the assumption that investors will never ask for their gold at the same time. It relies on confidence. But history shows us that confidence in fractional reserve systems always breaks eventually. When a crisis hits and investors get scared, they stop trusting the paper promises. They want the real thing. They ask for delivery. This is the equivalent of a bank run. In a normal bank run, depositors line up to get their cash. In a gold bank run, unallocated account holders ask to convert to allocated or to take physical delivery. If even a small percentage of the people who hold paper gold claims asked for the metal, the vaults would be empty in hours. The banks would be forced to go into the open market and buy physical gold to cover their obligations. This would cause a massive short squeeze. The price of physical gold would go vertical. It would disconnect completely from the paper price. But here is the trap. The banks have protected themselves against this scenario. If you read the fine print of your unallocated account agreement or the rule book of the futures exchange, you will find clauses about force majeure and cash settlement. Force majeure is a legal term that frees a party from liability when an extraordinary event prevents them from fulfilling their obligations. If there is a run on the gold market, the banks will simply declare that they cannot deliver the metal. They will cite market disruption or supply failure, and then they will exercise their right to settle in cash. They will look at the suppressed paper price on the screen and write you a check for that amount. You thought you had a hedge against the collapse of the currency. You thought you owned gold. But when the currency collapses and you need the gold the most, they will give you the very currency that is collapsing. You will be left with paper money that is losing value, while the real gold that you thought you owned is traded among the insiders at a price you cannot access. This is the ultimate rug pull. The paper market keeps the price low to discourage you from buying while simultaneously acting as a trap to capture your capital if you do buy. It is a system designed to channel demand away from the physical metal and into the financial casino. By absorbing investment demand into paper instruments, the banks protect the limited supply of physical gold for themselves and for central banks. And this brings us to the question of motive. Why would they do this? Why go to such lengths to suppress the price of a shiny yellow metal? The answer is that gold is not just a commodity. Gold is a currency. It is the competitor to the US dollar and to all fiat currencies. It is the report card of government fiscal policy. A rising gold price is a vote of no confidence in the central bank and the government. It signals inflation. It signals instability. It signals that the emperor has no clothes. If gold were allowed to rise to its true fair value, perhaps $10,000 or $20,000 an ounce, it would signal a complete collapse of faith in the US dollar. It would drive interest rates higher as bondholders realized that their coupons were paying them in a depreciating currency. It would make it impossible for the government to fund its massive deficits. The suppression of gold is a matter of national security for the financial establishment. It is part of the machinery of financial repression. They need to keep the price of gold managed so that the dollar looks stable by comparison. This is not a new theory. We have historical precedent. In the 1960s, the major Western central banks formed the London Gold Pool. Their explicit goal was to keep the price of gold pegged at $35 an ounce. They pooled their physical gold reserves and sold them into the market whenever the price started to rise. They openly manipulated the market to protect the dollar. But eventually the market forces were too strong. The demand for physical gold overwhelmed their ability to suppress it. The London Gold Pool collapsed in 1968, and the price of gold skyrocketed. We are approaching a similar moment today. The divergence between the paper market and the physical market is widening. While Western investors are being tricked into buying paper gold Eastern central banks, and sovereign investors are buying physical gold by the ton, China, Russia, India, and other nations are draining the COMEX and the LBMA of real metal. They are taking delivery. They know that the paper game is ending. They are trading their U.S. Treasury bonds for gold bars. They are preparing for a post-dollar world where he who has the gold makes the rules. The Western banks are playing a dangerous game. They are shorting a finite asset in a world of infinite monetary expansion. They are betting that they can continue to fool the public with paper promises. But the leverage in the system is getting higher and the physical inventory is getting lower. We are seeing signs of stress in the plumbing. The spread between the spot price and the futures price is acting strangely. The amount of eligible gold in the COMEX vaults that is actually available for delivery is shrinking. So what does this mean for you? It means that if you hold gold ETFs or unallocated gold accounts or futures contracts, you are sitting at a table in a rigged casino. You are playing with chips that the house can confiscate the moment you start winning. You are exposed to counterparty risk. The entire point of owning gold is to eliminate counterparty risk. It is to have an asset that is not someone else's liability. By buying paper gold, you are reintroducing the very risk you are trying to avoid. The only way to protect yourself from the paper gold scam is to opt out of the paper market entirely. You must own physical metal. This means coins and bars that you hold in your own possession or in a fully allocated, segregated vault that is outside of the banking system. When you hold physical gold, you are removing collateral from the banking system. You're taking a piece of the chessboard away from the manipulators. If enough people do this, the scam collapses. If everyone who thinks they own gold actually demanded delivery, the banks would fail overnight, and the price would reset to a level that reflects the true ratio of money to metal. There is a saying in the gold community: if you cannot hold it, you do not own it. This has never been more true than it is right now. The financial system is fragile. The derivatives tower is shaking. When the next crisis hits, liquidity will dry up. The unallocated accounts will be frozen. The futures markets will be halted. The only price that will matter is the price of the metal in your hand. Do not be fooled by the price on the screen. It is a lie. It is a signal generated by an algorithm and a printing press. It reflects the value of the paper claim, not the value of the asset. The real value of gold is measuring the devaluation of the currency. And by that measure, gold is coiling for a move that will shock the world. The paper dam can only hold back the river of inflation for so long. Eventually, the dam breaks, and when it does, the water level will equalize instantly. The transfer of wealth from paper holders to physical holders will be one of the greatest events in financial history. The paper holders will be left with lawsuits and cash settlements in a hyperinflating currency. The physical holders will be left with the purchasing power to pick up the pieces of the economy. This is why the central banks are buying. This is why the smart money is taking delivery. They are front-running the collapse of the paper scheme. You have been warned. The $10,000 price tag is not a fantasy. It is the mathematical inevitability of the current monetary path. The only question is whether the price will be realized in the paper market, or if the paper market will cease to exist before the price is discovered. Do not wait for the news to tell you that the vaults are empty. By then it will be too late. The premiums will be 100%. The dealers will have no stock, and the paper price will be irrelevant. The paper gold scam is the final defense of the fiat currency regime. It is the illusion that keeps the public asleep. But the cracks are showing. The math does not work. You cannot print gold. You can only print claims on gold. And eventually the world asks to see the receipts. Make sure you are holding the asset, not the receipt. The decoupling is coming. The rehypothecation chain will snap. The unallocated accounts will be revealed as empty promises. And the true value of gold will be unleashed. It is not a matter of if, but when. And when it happens, the window to exchange your paper money for real money will slam shut forever. Protect yourself. Verify your holdings. Get out of the banking system. The wealth collapse is coming, but for those who hold real assets, it will be a wealth transfer. Be on the right side of the transfer. I am Tom, and this is the wealth collapse. We shine the light on the dark corners of the financial system so you can see the traps before you step in them. The paper gold market is the biggest trap of them all. Do not get caught inside. Subscribe now and join the few who will survive the transition. The history books will record this era as the time when the world rediscovered the difference between price and value. Make sure you know the difference before the lesson becomes expensive.